All right, thanks for staying with us here on the marketplace. My name is Darryl Kwa. I want to begin with developments with the Treasury bills. We've talked a lot about it yesterday, and we're continuing today because US-based Associate Professor of Finance, Professor William Peprah, is cautioning that the sudden drastic fall in Treasury bill rates is not backed by the current economic conditions. He's asking government to tread cautiously. He joins us on Zoom to explain. Thanks so much for your time. And so what's your concern about this sudden drastic fall in Treasury bill rates? Why do you say it's not backed by the current economic conditions?
Thank you for calling.
Please go ahead.
Drop in the Treasury bill rate from 35% to roughly 19% is a little bit worrisome. When it comes to finance, there must be some kind of fundamental or technical forces leading to this sudden drop. But we could see that this is not the case, noticing that Ghana operates on an opening market economy. We've noticed that there is money supply in the system, which is being shown by the central bank's report. You see the M1, M2 keeps growing up. Investors' aim is mostly in period of inflationary pressures, like in Ghana, where inflation is around 53.6, is to preserve their capital or their investment. And that is why you see them mostly going to invest in government treasury bonds. At the moment, a sharp drop from that 35% to this 19 means that if you have your money based on inflationary pressures, your money would have devalued by 34%. When it becomes that, investors will start to think and find out where can we put our money that will be able to preserve it. And that is why it becomes a concern for investors. You will see investors moving away from government treasury bills and now investing in other foreign currencies that they think that will be able to help them to preserve their wealth or their investment. And this is what I am anticipating that probably in the short possible term is going to happen. Investors will be moving away from government treasury bills, and their next move, where they will think that they will preserve their money, is invest in foreign currency. And this may lead also to pressures on our cedi, causing the cedi to devalue more. And then as the cedi devalue more, it weakens the economy, and we come back to the same situation that happens in December, where we show a rapid drop in the cedi and dollar or foreign currency rates. Normally, the treasury bill rates, if it's pegged, or mostly it's a little bit pegged higher than your inflationary rate, and this is not happening now. This is where the concern is, and that is why I'm saying that we may have to understand or study why this sudden drop, which is not backed by economic theories, and is out of the norm.
Well, there are some analysts I've spoken to who are excited about this development, who are actually asking government to force down the rates further because it would reduce interest costs and consequently lending rates. You don't think so?
I mean, remember that you'll be able to, if you'll be able to reduce interest costs, you must also work on reducing inflation. Remember, any investor, being it an individual or an institutional investor, will want to at least preserve his currency above inflationary rates and not treasury bill rates. So you will see the banks and all other institutions still not bringing down their too much their rates as compared to this 34% or this about say 20% drop in the inflation rate in treasury bill rate that we have seen so far. It is not really going to have a major impact on cost of borrowing, because they will be thinking of how do we be able to preserve the wealth of our shareholders and stay above inflation rate.
Well,
yeah,
go on.
In finance, you see, your real rate as compared to you have to get the real rate, which is basically your inflation rate, and you add your premium. And this is not happening in Ghana. So the current situation of our Ghana economy and trying to force down the treasury bill rate will mean that investors will have to look for an alternative. If they really want to preserve, as I've mentioned, to preserve their currency or their investment, they will look for another source, which will be the best now is invest in other foreign currencies.
Well, but if you were in the shoes of the government, what would you have done in this situation where interest rates were going so high? A couple of weeks ago, they had to reject all bids because of the escalating interest rates. How can they maneuver? What can they do about it?
So first, they have to tackle the inflation rate. You don't use the treasury bill rate to tackle inflation rate. That is the problem. They are rather tackling the cost of funds that they are borrowing, but not addressing the main drivers of inflation in the country. So that is where the challenge is. The challenge must be government must work towards how do we bring the inflation rate down, rather than forcing to say how do you bring treasury bill down. As I've said, any rational investor noticing that even if I invest in government treasury bill and I'll get 19% and inflation rate is 53.6%, will want to find an alternative. No one will be holding government security. And in finance, there are some two principles which we call them interest rate parity. We also make sure that there is an exchange rate parity. We are creating an arbitrage situation whereby if I hold foreign currencies, I will be more better than holding government bonds. And this is going to come back again and put pressure on government. So that is why I'm proposing that for government to be able to maneuver, they must work towards policies or directions to bring down inflation rather than forcing to bring down treasury bill rates, which they think that it will have an impact on the cost of living. It's definitely no proper investor will be only looking at treasury bill rate. If I'm investing, I want to preserve my money, and I preserve my money only based on the inflationary pressures in the country.